stuff. So it was really just more of a little ad lib. What you guys wanted to see specifically, like what just tightening everything in, looking at different indicators together. What specifically did you guys want to see? Oh, yeah, that's a good point. That's a good point. All right, so generally speaking, right, and I'll look at crypto and we'll go through a couple of the different things. We'll go over just some basic stuff of like things that's useful and actionable. Let me just clear everything. So right off the bat, the big things that we'll start off with, just with auto charting tools, high time frames opened. I have this on every single chart without fail. Yeah, I draw my own weekly and daily SR stuff. If you want to know how to do those, it's really simple. You just find a weekly chart, right, and you look for bullish engulfing candles. All this does when you find these massively bullish or bearish engulfing, you can use bearish as well on the weekly, right? It's not. I wouldn't do it for everything, like every daily level, because it gets a little bit cluttered. But weekly SRs that are bearish do play out in the market or do play out in general. So where do we have? Oh, that's monthly. Why does it say monthly? There we go. So when you find these things, you look for bullish engulfing candles that, they don't have to close over the wicks, but the bodies of the previous candle. That's the important thing. Why? Because it creates demand zones. Demand is very simple. Price goes up and down like this. Why? Because up here, it's supply. There's more people selling than there is demand to buy at that price. And it, bounces up at this level because it's demand. Demand meaning there's more people wanting to buy than there are people to sell down here, so price must go up. Same thing as why price goes down, supply. Too many people selling at the certain price up here than there are people buying it, so the price has to come down so the supply can meet the demand. That's all we're doing. That's why price goes up and down. And when you come down to test these levels, they're testing if there is demand at these levels, right? So when you regain them as well, it's also important to note that regaining the levels shows regaining demand. Like here was some weekly demand at 20.8K. That's the thing that's holding us down right now. It's still supply. So until we regain that stuff, all of these levels are bearish until they're regained. So, plotting the bearish weekly SRs as well can be beneficial. Absolutely, 100%. I usually just plot the bullish ones for the free stream to everyone, just so people can get an idea and a perspective, like important levels and whatnot. So, once we have these things, even the daily and weekly ones played out, we can start seeing patterns. We can start seeing where price reacts. And, even here, by plotting the bearish, just the weekly SRs, right? It's not special. These are just supply and demands on weekly bearish and bullish engulfing candles. All of a sudden, you have a pretty damn reactive chart where price is reacting specifically at the levels that you're on. So it's highly useful. It's really simple.
And Chris, you always put your levels at the candle opening.
Yeah, so the reason I do that there's because sometimes we have gaps in the market. So like, if I'm on stocks or whatever, if you do this on things that are traded like this, you'll see that there's massive gaps in levels. The problem is that you can pull them either way. You're better off on stocks and things that gap is to like find bullish engulfing or bearish engulfing and creating a zone from the low of if it's a bearish engulfing candle, you want to pull it from that to that high, something like that. And that shows you the roundabout daily level that was created here. And you'll see that it's reactive both ways, even as it comes all the way down. It's very similar if you're doing demand zones, right? Demand zones, you take it, if it's a bullish engulfing candle on like the daily or the 4 hour, the bullish engulfing candle creates a local demand. So you take then from the high of the previous down candle to the lowest point it went on the wick, and that'll give you demand zones. Same thing as the upside to supply zones. Yeah, so this is basically it becomes a block then, like you said, right? That's the level that's interesting. That's the level we want to hold. If we lose that block, what happens? We have to go down to test structure. And then that comes with time of seeing like where the structure is. Can it hold something locally? Yes, in which case it would go there and then regain, and then we look for longs. If it breaks down and doesn't hold anything locally, we're looking then either for failure like this, comes down, tests, and then reacts bearishly. At that point, you'd localize the order block itself as being the most important thing for the level. And if you gain the level back, it's great. If you don't, then you look for shorts until it's regained. And that's literally how you play out your entire chart, right? Because what you don't want to do is get sucked in and like, I'm only looking for shorts on this chart, on this time frame, because it'll give you a false direction of movement. The macro is always the thing that matters. If you're going to a new chart, always start on like the monthly level and work your way down. Why? Because the monthly is the most important level. That shows you quarterly opens and everything else. Like here, what do we have that's super important in this zone? Well, we've got the current monthly level is potentially a bullish engulfing, but until we regain something like it closes the monthly out, like in 8 hours, that's the lowest we could possibly want it to go. Right? I think we're going to get it as long as we don't start collapsing later on in the day, right? So now we have 19,416, 19,255. That's the lowest we can go on the higher time frame and still remain bullish because we're above those levels. Currently, we've got some weekly SRs that are bearish and reactive against us. We've bullishly backtested the local stuff, but in the grand scheme of things, the only thing that matters at this point is to gain the local weekly structure. Until we do that, we're at the high, and we've been up here since Wednesday last week. So at that point, what I'd want to do is come down. The July Q3, these monthly open levels. Why are these always retested? These high time frame opens. They're retested because price to see if price still has a demand at these levels. And if the bullish retest on these levels is what you look at for longs, or at the highs up here, the bearish tests are what tell you to short. And you will miss trades, absolutely. I'd rather miss 20 okay trades and wait for the really good trade, which has confirmation of level, right? Like it was hard just looking at these to short up in this zone, right? And we went freaking completely off a cliff. The problem is that we have the thing that keeps us in check is the other metrics. So along with these levels, then we start looking at other things that are super helpful. If you don't like the levels as much, you'd rather play like local stuff, just having the SR on or the order blocks, right? You'll see a lot of overlap on these levels because that's why they're coded in. These are actually more accurate because they take volume into consideration. And then you start seeing real actual main levels on high time frames. What's the level we don't want to lose? 20K. If we lose 20K, what happens? We have to go to October Q4. Why? There's no other support, and we've lost the main support below us. Where are we at now? The main restriction. Gain of 21K takes us where? Probably up into like the 21.8 zone. This swing low from this daily candle. And they'll replot because as it moves, they add more levels or remove levels by volume. If they're not reactive anymore, they'll disappear. So it does replot the levels for you. So that's one way you can use it. The other one is also the volume blocks. And these basically put demand zones in by volume. So when I was, where's the major demand zones? When you have massive overlap like this, that's the main demand, right? Currently, this current 4 hour that closes in 15 minutes, it's creating a bearish demand zone. So if price or a bearish supply zone, right? Demand, supply. It's small, but if price comes back up here, what's that also? It's a weekly SR. That's where I look for failures to come back into some structure. It might be a little bit confusing because there's a lot of overlap, but then it basically shows you where all of the major demand in the zone is comparatively to anywhere else. Lower time frame, it's really reactive to find specific levels and levels to break out above or close below based off of if they're an existing supply zone or an existing demand zone. So this is just some basic stuff to get you like looking at charts from a horizontal up and down, right? Instead of like moving averages and other freaking nonsense, focusing on gain loss of level. Any questions?
Yeah, I have a question.
Go for it.
When you put in the order blocks, and you can see that there's a very strong demand around 19.2, something like that, right?
Yeah.
And if I'm correct, then the supply is not so strong. It's around the weekly SR 20.7, something like that.
Yeah.
So the price action would say that we have a very strong support around 19.2,
Yeah.
And then what would it take us to go below that level? So like
bearishly retesting October Q4. Like if it breaks down into the demand and then bearishly tests the level that you want it to regain, and then starts breaking that low, that's done. Then the demand's done.
But if we have a very strong demand at 19.2, shouldn't that push the price up higher?
If the demand still exists. So like this is existing demand. Like unfortunately, like we can't look into the future and say where demand and supply is. We know that so we have existing demand based off of what's already happened. It plots these by filtering them through volume and volatility to say which ones are the most important. Even if we lose this block, we've got some smaller blocks like at 19.1, and then what's the stuff we can't lose? Down here where it starts overlapping at 18.6. That's the levels we can't lose. Because then what happens in the overall structure? Now we're breaking down basically into the lows and potentially losing the floor. To the upside, looking to the left, what do we have? We got this big order block up here. It coincides perfectly with a weekly SR. And anytime you start seeing overlap of your own manual levels, which we're working right now on a thing that automatically plots SRs for you, just because I use them every day and it'll save everyone time, which is the whole point. So we're working on that to plot swings. And what's that?
Sounds fantastic.
Oh, thank you. But yeah, I know, but it'll be. Yep, be like, oh, that's a level. Oh, that's a level. That's the whole point, man. That's like it was funny. I was talking with a guy who's a he's my neighbor actually, and we just met. He's a German dude, and I was like, and he's really into crypto. I'm like, no way. He's like, yeah, he's a certified blockchain technician, like software engineer, and has worked for the Blockchain Foundation. Like, really cool stuff. And no, he's I first started telling him about what we do, and then he's like, oh, it's like one of those indicator things or signal things or whatever. And then I showed him, he's like, holy shit. And I was like, yep, that's our motto is be the gold in the river of shit. And and that's like literally what we're trying to do in this entire market. And simplifying this stuff out. Like that's why I want to auto plot weekly SRs. Any moving average stuff, at the end of the day, it gives false data. If you're using RSI and MACD alone, guess what? So is every other retail trader seeing the exact same thing, and which is why the market makers are admittedly so, like Alameda Research, they are so like they manipulate the market so much it's insane. And talking with them, they don't do TA at all. I'm like, what? So how do they trade? Well, they look at what retail's doing and do the frickin' opposite. Oh, retail wants it to go here. Well, let's print out a frickin' head and shoulders pattern, right? Say the dirty word, and then run it down and then send it off, to new highs. That's what they do. They exist. The market makers, especially in crypto, because it's so unregulated with spoofing and all these different, tactics that they can do, that they will literally print out something that traditional TA would tell you, like, oh, but that's the 3 bullish daily candles, or that's like an abandoned baby pattern, or whatever the fuck. It doesn't matter. Like, don't ignore that stuff. Just look at the horizontal levels. So, yeah, and like going back into the indicator, so don't go on a freaking tangent and I start complaining why there's such scammers and scumbags, and every guy on YouTube has like a picture of them making an O face, like, oh, we're going to new highs, or like, some German guy screaming at you and like, oh, but it's the triangle, and so, you take the average of the triangle size and then you put that below it and that's the target, and like that stupid shit. Like, just focus on the horizontal stuff. Gain, loss of level. Yeah. So yeah, like triangles sometimes play out, but most of the time when you see a triangle, two things are happening. A, the market makers want you to see it, and B, everybody else sees it freaking too. So don't play it. Don't mess with it. There's no point to it. But yeah, he's focused on this thing where it's like, yeah, if he comes down and makes a bear flag triangle and then does one of these, you take the distance between the high of it and the low of it, and then that's your distance target to the downside, which is based off of nothing. Absolute nonsense. But
a lot of guys do that actually. Gareth Soloway is a big one. He does it too.
Dude, these guys are worth they make so much money off their ref links. Like Smolio was in Dubai with them, like because we know a couple of the guys back last Christmas? Yeah, and I mean some of these guys are making like $100,000 a day off of ref links just by I mean like, and the stuff they shill is just terrible. It wrecks retail. So. Don't want to be anything like those scammers, as far as I'm concerned. Plus they get paid to shill products and projects, which is at the end of the day, if somebody's telling you to buy something and they're like some fat neckbeard like BitBoy, do the opposite because he's already.
Sorry, guys, just laughing.
No worries. But yeah, so as far as the levels go, I like order blocks. Plotting the weekly SRs, I think, was probably one of the easiest things to find levels. Because what do you end up getting? You end up getting a chart that literally shows you where the reactive levels are. Even without that, just by itself, you see the levels to gain, the levels to lose, the levels to fail at. If we gain the weekly SR at 21 and we put everything else back on, where do we expect to go? Probably up here, right? I'll go on the 1 hour, so it's even more clear. If we gain this, here's a supply zone block, and it's the weekly SR. That's where I want some type of retracement. So when you find these levels, what's the main thing above? 22.7. If we get above that, we can start targeting stuff, but until then, major failures. Extra market stuff, yeah, you can consider it, but at the end of the day, I think the indicators are powerful as their own, and I don't trade the news. If there's news events that are coming up that will affect the markets, 9 times out of 10, I won't be in a position, or I'll be in a position for much further before, because more and more we're actually watching that people pay attention, or traders pay attention to the FOMC. They pay attention to economic calendar announcements. If you haven't looked at it, economic calendar or investing.com, it's free. Sorry about the white screen, it bugs me. This thing is great because you can set it to your time and then target only like highly volatile, important things. And then you just look at the week outlook and you get all the major news event data. So, dollar reacting very bullishly, Dixie goes up, markets go down, generally speaking. It's kind of like the way it is. And, we have the Fed interest rate decision on Wednesday. It's expected 4%. They've said they're going to 4%. The market, if it goes to 4%, the market's still going to react on it because everyone's reactive trading news, which is dumb. That's why it's going to be more of like a show where we're watching it together, and I'll drink some beers and like laugh about it. But at the end of the day, like these are important news events, and it's really good to keep an eye on stuff because, especially for the U.S. markets, if you're trading crypto, the dollar is still king when it comes to crypto. So that's the liquidity. Tether's tied to the dollar. Everything's based off it. So looking back at this, a lot of information. We see that, core trend is great because it shows you like where stuff is and where stuff is going. So you can see like macro trends. For the guys who are interested in automation, by the way, I've talked to Mr. Bing. He's going to have another session on Thursday where he walks everyone through clicking, connecting, and then also he'll do a part about finding really good settings and some of the things that really help as far as filtering trades. The ATR filter, it uses average true range. It basically just pulls some of the bad filters out. And then a high time frame filter. It needs bullish or bearishness at a higher time frame than you're currently looking at in order to action a trade. And we got some really good, we got some really great strategy back tested values on it. And so we'll share those as we come out with everything. Overall, even just having it as is, it's like, there's a lot of chop and whatnot. At the end of the day, the win rate is a little bit, I think it's about 45%, 40%, which that sounds on face value bad. But if you're automated trades, the win rate is not as important as the max drawdown, right? If you're testing strategies, so max drawdown, like ours is under 5% on the 1 hour for Bitcoin. That means that at no point has it ever lost more than 5% of the trade in a position before exiting the trade. And what that does is that prevents you from both getting liquidated if you're in leverage positions, and then being able to see, besides the profit the max drawdown, you have the profit factor, and that's what the important thing is. So overall, right now, this thing's at about 300% on the year just trading it as is, which is something that can be click and connected and automated. Then it's about the patience of letting it run, even if it's starting to lose, even if it loses some trades and chops, it'll catch every major move, right? Even here, it got you out, not at the high. Why? Because you don't short the high any more than you exit positions entirely at levels. You can, right? And it literally went from the low to the high, if we look at the weekly SRs. But all this stuff is that as price comes up, you're looking to take profits intermittently, right? You break the local high, take a profit target, right? Gain above the September level. As soon as price hits that, you take a second one. At that point, you look at your weekly SRs. Next weekly SR, you take a third one. There you go. And the whole time, like the simplest way to do these trades is that once you take, somewhere between your first profit target and the second one, somewhere in here, you move your stop loss, which is, wherever it is, to your break even, to your entry. At that point, two things have happened. A, you have a free trade because you have no risk of losing money. And B, you've already taken at least one profit target. Like, I cannot stress enough, like, good traders market in and market out and forget any principle of taking profit. Because what you're doing then is you're paying significant fees. You should always try to limit in and out. If you limit in and then take, a limit short, or to get 20% of your position on the first profit target, maybe 20, 25 on the second one, however you are comfortable with trading it, you're keeping your positions open and open longer. And eventually, down the line, higher time frame, as you get better and better, you get hedged. You start hedging yourself on everything, which is, we have shorts going all the way back into the high 40s. And we still have them open. We've gotten some spot exposure as a hedge in case price wants to go up a lot more now before it goes down. And that's the whole point. Because if you're short and constantly taking profits, and you're long and you're constantly taking profits, and leaving the positions open, and when things do, like, have buying a higher low on a higher time frame, that your entry or your trade entry position might come up. But at the same time, you're staying within the trade longer to make more money. And not to mention the fact that these longs are now completely at zero risk because you can't be liquidated on them. Just like the shorts. Our stop losses are massively in profit on these things. So there's no way we can get liquidated. They're free shorts. So all we do then, and this is a trick that that's really, really fundamentally powerful, is that when you're in profit, and let's say you want to get more exposure to different stuff, but you don't want to risk getting liquidated. Well, what you do is 10x, right? 10x on a Bitcoin position. I'm comfortable with 10. Once it's in profit and my stop loss is in profit, you know what I do to my margin, like my size? I make it 100x. I jack up the leverage as high as possible, and then I can pull that extra like 90% of that position out, and I can put it and allocate it somewhere else, and it can't be liquidated because the stop loss is in profit. And that's how you maximize whatever margin you have in order to trade multiple positions at the same time. So that's just a trick you can use. You need to be really specific. Like, don't use cross leverage. Cross leverage is a liquidation machine. Isolated margin, 10x positions. That's the best way to go about it, I think. But so that's enough about that. Any questions about that little stuff about the entering and taking profits? Anything that sticks out? Yes, no, maybe so. Okay. So looking at the structure, right? We know where the levels that are of importance are. We've got the high time frame opens. We understand why supply and demand zones work. We understand why weekly support and resistances, both bullish and bearish, why they react. So now we're going to use our other tools that are really helpful. So the oscillator, I trade almost always on crypto. So I got the on-chain metric bundle, and I've got the collated funding. So starting off with something simpler, we'll look at funding, right? Funding is very simple, that exchanges use funding to manipulate price by making shorts or longs more attractive to liquidity providers and market makers. So if bearish funding is getting like above 0.01 positive, right? Positive funding equals shorts are incentivized. Negative funding equals longs are incentivized. And anytime you start getting over the minimum threshold for like the fees, like, you know, if you're paying fees, you know, to take positions on leverage, because that's how they make money on, because they're basically giving you like a short-term loan. I mean, it's not really, but it's the best way to explain it. So you're paying a fee to do it. So anytime you start getting like minus 0.01 and all these things, it's very, very lucrative for people who are market makers and liquidity providers, because these guys have, you know, millions of dollars and they get paid to fill the books with liquidity. It's not like Binance owns like 100,000 Bitcoin and that provides the liquidity for the whole market. No, they have contracts with liquidity providers who have a minimum to say, hey, you have this amount of money, we'll pay you and then reduce all your fees for your trades to like zero or barely anything if you provide, I don't know, $100 million of liquidity a week in trading volume, right? And then that's how they ask it for. They ask for trading volume, because what you're doing is by limit ordering, right? Filling the books, you're making versus taking. Taking is you know, like when you hit the market smash into a position. That's why when you hit market smash in, you get charged 3 times the cost of a limit order, because you're not a maker, you're a taker. That's why maker fees are different from taker fees. Market makers, liquidity providers, they always limit in. Why? Because they make money off of it. They make money passively by providing liquidity. So understanding that the funding works, that they are exchanges manipulating price, as they say, to keep the spot price and the futures, you know, inverse perpetual derivatives, whatever you want to call it, as close together as possible. But we also know that by their own admission, they use funding rates to manipulate the market. Do we think they only do it for that? No, we know they don't. Right? We have an example of it, for Christ's sake. Like right here, we have a massive spike. Oh, what happened here? If we turn on funding rates, because it pulls from 7 things, it's the majority of all of the volume in the markets is being shown here. You can look at individual. Orange is Bitcoin, blue is Ethereum. Or like in history, blue is almost entirely stagnant. Like at times it gets more bullish or bearish, but here we have ETH massively bullish funding rates. Why did they do this on this date? Oh, maybe it was to protect the ETH merge so it didn't get nuked on right away. And then as soon as it was done, people made shit tons of money providing liquidity. Then they pulled all of it by here, right? ETH liquidity basically went to zero again, or funding rate went to basically zero like the next day. And then price went down further. They did this to manipulate the market to prevent an ETH crash as people start massively selling shit. So there you go. It's evidence of them using to manipulate the markets. Funding currently, right? There you go. Maybe that's a little cleaner. Funding rates, and we're looking on ETH now. At the end of the day, it's Bitcoin that's manipulated the most. So when you see massive bearish funding come in, even for Bitcoin, right? It's not the fact that there's bearish funding and shorts are incentivized. It's that when they start pulling funding, that's usually when there's a move coming up. When they start increasing from bullish to bearish, when they're at a high and then they start pulling the funding, the move is happening. So in a sense, it's a leading edge indicator, right? You're seeing stuff happen in funding rates before the actual on-chart move happens. So that's what I use the funding rate for, and then to see if there's outliers. If there's massively like bullish funding rates, and price is still coming back down, then I'm looking for longs in the zone as bullish funding increases, which if this thing continues to come back down, that's what I would expect to happen. Bullish funding come in, it would probably ideally it would wick down, break the low, and then the long is the regain of the level, right? That's bread and butter stuff for me, is break a level, regain. Any questions on the funding stuff? No? Yes?
Yeah, I have a question, just a quick question. I saw that you can choose all the different exchanges, right?
Yeah.
But if I'm only trading on Binance, should I just use Binance or should I leave all the exchanges in there?
I recommend using all, because Binance and Bybit and most exchanges actually only change the funding rates every 8 hours. They have 8-hour periods where they change funding rates. So if you only turn your thing on like you're going to have a totally different perspective of what the funding rates are, right?
Mm-hmm.
So it can give you a perspective specifically for that. But again, we put a smoothing in there to see how it's reactive to the rest of the market. And it gives kind of like a false narrative of like what's going on in my head. The biggest... Exactly. So its default is volume weighted because I don't care if one exchange, like maybe Femex, has like negative 0.5% funding or some shit. I don't care. I care about the total volume because now I'm seeing the entire crypto market, right? I've got all of the 7 biggest exchanges by volume, and I'm seeing what their funding rates are in real time as it's updated. Because it also smooths out where there's outliers and you get an average and by volume. And if you don't have an average by volume, you're seeing one piece of the puzzle and not the whole thing. This is the whole puzzle. So I'd say I like it as is. If you find something that works better for you, do it. Like, ignore me. Like, that's my like one big rule, right? If I say something and you're like, you don't agree and it doesn't work for you, ignore if it's working. It's all about, like, if it's successful for you and you're making profit off of it, cool. Do it 100%. That takes priority always. So, but I guess to answer your question, yeah, I'd say leave everything on. Otherwise, you're only seeing for your exchange and not the rest of the market, because the whole market is what we want to see.
Right. Thanks.
No worries. Cool. No worries. So we'll look at the oscillator too, because I think the oscillator is probably one of the most powerful things we have. So what we're basically doing is we're taking a bunch of different things for strength to find like the thinner line, right? And for trend, we're trying to see these bigger movement directional indexes and some simple moving average stuff to basically give us a more clear direction of what the direction of trend is and the direction of strength. Because if we just had strength, you'd see a lot more chop. With trend, you see the general move of things. What we'd like to see is this as well. You can adjust the sensitivity. It's important to adjust the sensitivity on these things like together, especially if, like, as an example, if this thing, like, something's really strong in an alt and it's just topped out the whole time, you need to adjust the sensitivity because then you can see the bigger moves in it. Even if price is kind of like staying toppy, you can then see like the lows of the moves and the highs, and you can scalp it. The dashboard, I think it's pretty interesting because it shows like reversal things as well. It's not the most useful, but I usually just do it as like a check to see what's actually happening. What do we have for reversal percentages? What's the higher time frame trend? This stuff just kind of like I check myself because I want to make sure I don't want to counter trade everything, right? We look for reversals, but your reverse, like taking positions, if the trend is down and you're only looking for longs, you've got the wrong idea. Because what happens is when the trend's down, you want the major trend is down, you want the trend to continue, because then on pullbacks, you can re-enter shorts. And you'll be more successful. It's basically just simple, trade the direction of the trend. Because if you do that, like re-enter on because that's a small reversal, it's a swing, it then reverses. And if it follows the same higher time frame trend, that's why you defer to the high time frame trend. Because it helps you stay in positions that are in profit. Because if the trend's down and it's consistently making lower highs and lower lows, your more profitable positions are not going to be longing these and then scalp. It's going to be shorting these, and then you have bigger moves to the downside. So that's kind of like a check on myself, just to make sure that I'm not seeing something that's completely random and off on the market. As far as the oscillator itself, I always have the divergences turned on. Hidden, yeah, sometimes. But for me, the regular divergences, because they play out much more. And the hidden ones are a little bit scary because you're like, oh, but it's diverging and it's all this stuff. The basic, easiest way to explain divergences is hidden divergences are retrace before continuation. So hidden bullish means you've got like a little bit of a retrace to the upside usually before it continues the trend. So I kind of leave them off. So I'm looking for trends, right? I'm looking for which direction. The bearish regular divergences, those are high probability of trend reversal. Because you're seeing that, as an example, right here, why did we get that? Like, that doesn't make any sense. Well, like even here it was regularly diverging. That means the move can still be playing out. It's diverging because price went higher than the previous high, but strength went lower. Same thing as bullish divergences, right? Price went lower than the previous low, but strength is higher, right? That's going down, that's going up. So those things are usually a powerful confirmation to me of like a potential big move. As far as the oscillator itself, yellow dots, I start getting really interested. A lot of times, especially on anything below the 4 hour, when you see yellow dots and like these blue dots are showing like trend changing potentially, you want to wait for like a blow off and then a failure, because that's almost always what they end up doing. Is because what they do is these divergences, people see strength and trend, even though we're filtering stuff, we got a lot of ways to harmonize the different indicators so they actually give accurate data. You want to wait then still for the manual failure at levels. So here's the move's coming to an end, right? Here's where we have like the reversal dots potentially, but they're firing early. What do we wait for? Blow off and then failure. And then what do we have? Then we have trend breaking down all the way down to major levels. So hope that any questions about the Harmony oscillator or anything that you guys have questions about that in general. Yeah, I gotta turn this off. I think it's pretty straightforward. It's probably outside of the auto charting tools the one I use the most. The core trend will eventually be phased into an automation only thing, just because of the power that it has to automatically execute and the alert system built into it. So finally, I'll do the new one that everyone got, the crypto online, the metric bundle. And if you don't have access, just send me a message or create a ticket. We're revamping our internal system right now with APIs and stuff. So out of this whole thing, I think it's pretty cool because it shows like the on-chain ratings on average, right? Pretty bearish outlook generally currently if you just look at it from face value. So that's an interesting one to see as well. With the on-chain metric bundles, the ones that really stick out, because we have the simpler versions for like the collated open interest, which right now the updates for this are going to be showing divergences and showing basically points at like alert systems where it's like, hey, I'm interested when like the open interest massively goes to like 95. This thing's inverted still, right? There you go. Now it's right side up. Most of the time when we have massive like levels, anything over 95, when it's ranging, it's a very range-based thing. It's usually the highs in the local area, right? We see that because people are longing enough where open interest is built that it moves. The move is more effective. Right here we have price holding, but open interest dropping all in chain. That basically has me thinking that we could definitely do another leg up if we don't want to lose the floor, which is also possible. I think the on-chain metric, the oscillator for open interest is pretty cool. The ones that I really care about are the ones we can't release to the public, only to you guys, because they're just too powerful. The higher time frame one that's really important is the holders in profit, or hodlers in profit, right? What this shows is the net on-chain hodlers, like long-term holders of Bitcoin, if they're in profit or not in profit. And anytime it starts getting up in this like 90 percentile range, we're getting pretty damn close to the end of the move. Actually, I'll go on BLX because that makes it easier to see. Right? When do we actually get the true lows in bear markets? It's when the net hodlers, like the long-term holders of crypto, are way underwater in like the 25 zone. COVID crash. But wait a second, that went as low as the lows from 2019, but it was 2020, and the price was significantly higher, right? And the reason for that is 43% higher, but it still went down to like that percentage of people are, only 25% were in profit. Well, that's because more people are buying in and hodling. So to have a true market bottom, right, you'd want to have price on this is why I don't think this is one of the reasons why we don't think the low is in, right? Because right now we're barely at 20K. and the holders in profit are at 56%. So the majority of long-term Bitcoin holders are still in profit. Psychologically, market movement, all that stuff, that means I'm expecting we get back down to here, right? To this low. I don't think we're ever coming back down here. We do have targets that if we start breaking stuff to come down to 6K, I think that's a little absurd right now. But I think somewhere around, where is it? There, 10K. I think that's possible. Another 50% move down. Very possible. And I think that would break us down under 40, probably down in this zone. And I think it's very possible at that point that would be the floor dropping out. And again, even using the order blocks, we're on the weekly level. We're the major weekly order blocks above us. That was the floor of the previous bull market, right? That was the low of it. That was the monthly SR, which was the monthly floor. What do we have now? We've got the major stuff between 14K and 10K, 10.5. That's the full bull market retracement. If we hit that, anything that creates new lows from the current low, my DCA bots turn on, and it's accumulation time, 100%. So that's a really powerful one for looking higher time frame and having like a general market outlook for crypto. The one that I think is one of my favorites, and I'll do long-short ratio crossover. It basically shows like where people are getting massively short versus long. Oh wait, that was wrong. I think I just broke it. There we go. So, when we start getting overly long on the higher time frame as well, again, when longs are in control, we're usually looking for a drop off. People start shorting too much, longs again come in. So lower time frame, I think, is the more effective one for this as well, because you can really see moves and then see, but people are longing up here. We are getting a little bit toppy on it, right? It doesn't mean we have to break down, but it's definitely more possible than breaking to the upside at this point. So that's an interesting one. And then my favorite one by far, I won't go whale bubbles. This will show you like where there's significant on-chain activity, like large amounts of Bitcoin doing stuff. And a lot of times you'll see this at the low of moves, where people will be buying, and then at the highs of when the bubbles are on the at the top of moves. That's usually when you see like on-chain selling and stuff like that. So that's usually how you can read these bubbles, and it's just interesting because then you see where people are buying and selling stuff. But so my favorite one, and by far in my head the most powerful, and I've set a bunch of alerts. So if you do see those in the premium alert section below, where I have like 1 hour core trend, 4 hour core trend, 15-minute, 1 hour, 4 hour crypto alerts, those are the places that you're seeing the alerts. Like the core trend stuff is the core trend firing, right? The 15, 1 hour, and 4 hour alerts, those are off the oscillator and on-chain funding and stablecoin demand. So what I want to actually, I had to do the funding ones. I haven't done those yet, but the funding ones are coming, so that's going to be cool when those actually come out when I'm done with them. So this is really interesting because and again, like I said, the retail stablecoin demand. I don't know how they left this open as far as like sourceable data. It's literally a freaking cheat code for the entire market, because you see for crypto where people are exiting and getting into stablecoins. And it's like, but wait a second, like it's kind of like counter trading the market. The simplest way to do this is invert it. Right? If you invert the thing, it literally says when we start getting to, there's very, very, very low demand for stable coins, that means that people are allocated into crypto, right? People are exposing themselves to more risk by being in cryptocurrencies. When there's very high demand for stable coins, it's because people are exiting the market into stable coins. And basically it's like when they're when retail is exiting the market enough, the price will go up. When the demand for stable coins is too high, or too low, the price will go down. So, and one of the easiest ways we found this, as an extra layer of confirmation, and that's what we look at, right? We want confirmation level. Let me go back to this one and turn that off. So what can we do with this? So what I do is I'll invert the chart, right? So load it because it follows with the flow of price action. And then I'll add this to the existing pane below. And now we've got stablecoin demand because we're trading crypto, right? Overlaid with the oscillator. And every single time, this thing bottoms out, like entirely, or tops out and gives you like blue dots, yellow dots, you're getting close to it's always the top or always the bottom. So when they're moving separate from one another, it becomes a little bit more sketchy because now you have some deviation in the things that usually move together and you're interested in them. Lower time frame as well, even like 15-minute, right? Because everyone likes to trade low time frame. Anytime you start seeing deviations, and we're going to get the deviations in the next update for this thing to put in because they're super powerful, right? Massive deviation here as price went up. So there's a lot of stuff we can do with this, and over I'm seeing that overlaying stablecoin, retail stablecoin demand, and when they're trading together, you can almost entirely time tops and bottoms for some of the easiest trades. And then obviously when they're rejecting levels, right? So looking at the weekly SR stuff that we have above us, interesting levels. We know those are important supply and demand zones. Price is topping out. Actually, let me put this on so the horizontal so we can see it, right? Price is topping here in strength and retail stablecoin demand. People are freaking out. So that's the bearish deviation on everything, right? Price goes up, strength, trend, and stablecoin demand deviates to the downside. The deviations are the key to finding tops and bottoms and then playing those. Price comes back down. Stablecoin demand gets very, very bullish. Oscillator gets very, very oversold. We're at the September level. Reaction, retest. Every time. And it plays out over and over and over again. So that's just something that we found right now that's super powerful. So when they're giving the same signals, it's layers of confluence. We've got, stablecoin demand, strength, trend. We've got, the yellow dots, which are crossing, which means that strength was really high and is crossing back below. And then the blue dots, which are showing trend change. So think of it as you will, especially at major levels, right? Didn't want to show this on the stream, but look at that. We have a high, price is breaking down, blue dot, stablecoin is, demand is retracing, and we got a failure at a major level. And that's why I want to code the weekly SRs in, those things, because it just makes it that much simpler. And that's all we're doing, over and over again. Right? You can put core on because it'll auto put you on scalp mode, and what do you know? The thing literally starts popping short, like the short scalp trading shading at the weekly SR. Like, here's your sign. Any questions?
I just have a quick question. When you guys update the indicators, will we have to delete them and re-add them, or will it update?
No, you just have to refresh your chart. So like the update will push through. You should get an email notification to whatever it is that the thing's been updated, and then just refresh it. And if it still has a little bit of trouble to fill, then just exit the indicator, and then just re-add it to your chart. That's usually what I do anyways, but it shouldn't be. It's becoming almost entirely seamless at this point.
Fantastic. Thank you so much.
You're welcome. But yeah, this is literally how I've been scalping. Like 15 minutes. I did a bunch of degen scalping over the weekend and literally just shorting levels over and over again. Core trend automatically switches to scalp. I didn't take it, and now because I wasn't even looking, I was prepping for the stream. That was the easiest short you've probably had in a while, right? In a supply zone, generally we see only red. We've got the scalp shading popping, weekly SR failure, overbought on trend and strength. Retail stablecoin demand is very, very high, right? Because people are scared. Yeah, exactly. So, but this is, that's the crazy thing. Like, over and over again, we're seeing the power of these things together. And now you've got so many things of confluence to be like, it's not 100%, right? Like, I want to make that clear. This is not a 100% thing, because nothing is. Anything that's 100%, I'm telling you right now, if I find something, I'm probably not telling anybody. Or I'll just start auto trading it or something. Like, those things don't exist. Like, just statistically, there's no 100% thing. Right now, and looking at, what other stuff that's on there and other systems, especially when related to Confluence based, this is the best thing I can find and the best thing we can do. And we're only going to make it better, because the next big push of product stuff is going to be on the website, because then we have actioning orders and whatnot through our own system. So going to be pretty powerful. So I hope you guys like it. Any questions on this stuff right here? Anything about the indicators? Ooh, I went about an hour, as long as I was expecting to. So anything else? Oh, the price projection stuff? Yeah. Okay. Absolutely. This is a little bit of a mind blower for a lot of people. Let's see if do I have any saved? No, I think I deleted all of them. Okay. So everyone knows what 618 is, right? The 618 is like the golden ratio number. What people do is, and market makers have been doing this for decades, right? And we basically learned this from some guys who were doing over-the-counter stuff at banks. And this is how they do price projection models in bull runs, how they do price projection models for price discovery, and even bearish price discovery, right? Because it's an entirely different ballgame. If something's just pumping to new highs, how do you predict where it's really going to go? So what you do is, and I know it's going to sound stupid, but you find the low in the structure, right? So here we're going to pull 2 and see if there's any overlap. So you find the low in the previous structure, like the previous swing. So what was the low that took us to the high? Like, from the low to the high, where was it? It was here, right? It was the COVID crash. That was the lowest point before the high. And since then, yeah, you can pull them closer, but that's the total low on the chart that we care about, right? So what we do is we find the low, then we find the high that came after the low, which is that. So that's the low. That's the lower high, that little, this high here. And then we pull a fib from the lower high to the higher low, which is that. That's the higher low. And what that looks like, we pull a fib. You can hold control to toggle this thing, the magnet. That's typical fib retracement, right? It doesn't really tell us a whole lot. This is where it gets pretty freaky. So from this level, from the low to the high, I'll turn this back off the thing. We've pulled a fib now. And what we're doing with the values is that we're taking them in multiples, basically in ever expanding, just doubling the number. 0 to 1, you want to show that because that's where the fib's being pulled from. Then you show every 618 that's a double. 1, 618, 2, 4, 8, 16, 32, 64, 128, 256, all the way up. It's like, okay, but these are random ass levels. They're not. Every time you start gaining levels and holding them, they become the most important part in the zone. Popped above, regained, rejected, went to the mid of that previous one. Gained above, where do we go to the next one? What's the thing that takes us to the next one? Price goes, makes it low, breaks above, holds it perfectly. That's the potential long continuation. Price breaks, go to the next level, breaks above, it's support, support, support. Goes to the next one. Reacts and rejects up the first one, comes down, tests previous structure, plays around a little bit, comes back down. Where's the floor? 30K, right? Goes back up, breaks above, swing fails, and then breaks under. You can do this on any chart, on any pair, to find out direction. And as an example, like, let's say, what's the downside price projection? Like, how low do we think price can go? So we'll do the same thing as bullish price projection. Let's look to the downside. So what do we do? It's the easiest way to do it. Just invert the chart. Where's the low? That's the low. Where's the higher low? There. The lower high is there. The higher low is there. And then flip her right back around. What do you freaking know? For those guys who've been with us since March, that's where all of us got short as fuck. Yeah, we were shorting up here, but like that was the big one where it was like, yeah, it's over. What are we looking at to the downside? Well, you can also fill these levels in. You don't have to do exactly multiples of double. That's a way to do it, and I think it's an effective way. You can also just write, every 3, 4, 5 all the way down. And, I do have log on because I only look at logarithmic, but just bear with me as I fill these things in. And it starts getting really freaky. Yeah. I need to. No. Look at that. Like, we don't make this stuff up. Like,
this is freaky, like Matrix shit that you're showing us.
It is, dude.
Oh my God.
Isn't that crazy? Like, what are the odds statistically that it would react perfectly on these levels? Right? I mean, not like kind of, but I mean perfectly. Rejection. Doesn't even test it. Off a cliff. Comes back down, starts losing the level, off a cliff. There's going to be more and less confluent spots. Gains above. What becomes support? That. What's the rejection? Literally to the dot. What's the hold? 18.6. I didn't make that up when I said, like, that's my main swing on the chart. Why? Because if we lose that, we're going down here. Going to 15. If we lose that, where are we going? Down here. I can plug them in so we can, like, game the whole game out.
What is the explanation for this?
The explanation is that the big boys use it. The people who almost the entire market is volume based by algorithmic trading.
Right.
So I think in the general markets, something like 75 or 80% nowadays of all trades are actioned by algorithms, and there's quite a bit of over-the-counter stuff being done using these fibs. Again, this is our downside targets. What do we do if we lose the floor? We'll set it on stream. We're going to 14.5. Why? Because we have to. If we lose that, that's where we got to go. Go to the upside. Where are we going? Are we going to stop at 27? That's where we want to see a rejection. But realistically, we'll probably go straight to 30. Right? To the downside, what happens if we lose 14.5 or 14.5? Where are we going? The downside of the entire move. If we lose that, 6K, literally to the dot. And it lines up with all of our other data about where levels can go. We could get a wick down there, and then that's the low. That's done. Like, because anything below that, and it's basically becoming like 3K, and it's at that point it's conditional failure for the market. So they won't let it go that far. Could go, but I don't think it's going to go under 10. Or if it does, it's going to wick real hard and then get bought back, and then that's the low that's in. And you can do multi. Yeah. Yeah, exactly. So maybe that is what we need, right? To have a full market crash. As we always talk about in the emerging technology life cycle, right? We've got, everyone's seen me draw this curve, I think, right? This is the innovators, right? That's like less than 3%. Then we have us, the early adopters. That's something like 8, 9, 10, 11%. Then we have the space between the majority adoption, this area here. That's the chasm. It means it's like the same thing that happened, like why America Online and all these other things crashed during the dot-com bubble crash, right? Complete wipeout of 90 to 95% of the market. Then you have, the early majority. That's 40% adoption. You got the late majority. You're now at like 75, 80% of the market adoption. Then you have the laggards. And then I forgot what the last one is, but it was just like people that are skipped. It's like your grandma. Like my grandma is 94, and she does never own a computer. She was skipped from that technology life cycle, right? The laggards are the ones that are like, oh, their grandma's like maybe 75 or 80, and you've taught them how to use a computer over the last 15 years, and they still kind of don't know what the hell it is. Late majority is like, the boomers, right? They're all in technology. They have smartphones, but the adoption, they weren't buying the Blackberries, right? They weren't buying like the initial iPhones. Those were like the early adopters of that technology. So that chasm is pretty much, if it doesn't happen this time, it's got to happen next time. I think it's happening right now. And that's what we always talk about in the emerging market technology life cycle. Is that always has to happen. Because then the institutions that have all the money get to consolidate power, and that's pretty much all they care about. Let me see if I can pull another one from the low. This might give us a better perspective on the... So, where's the low? There. This is a little bit of a jankier one. I don't like that one so much. Low. Maybe even go lower time frame on it. You can do it from lower time frames too. You can do it from like the 15-minute and shit. It's there you go. Let's pull it from there to there. And then let's turn off this 618 and we'll go back to the natural doubling, right? Change the color to red. Is it reactive?
Jesus Christ.
So let me go back on the daily and see. Yeah. So I don't like that fib as much, but I mean, it's still usable, still workable. You can do this in lower, like small areas as well. Like probably a good one would have been like down in here. From that high, that was the low. We'll pull it from the higher low from that. So we'll just do from that to that. See if it's reactive. Literally called the top exactly. Oh, sorry, within $100, so it was okay. You can do this over and over again. And like what we usually do is we'll pull like 3 or 4, and then we'll create boxes where there's overlap. Like main level. Like we'll basically find that. And Will does this more than I do. So he'll find like that's the major level, and then like what's the next one? Something like that. What's that? That one's oh shit. That one's a better one since it's closer and tighter. Right? That level there. Exactly, and that's all. And that's all you're doing. You can do it on any chart. Like, let me see, like BNB. Let me just group these and turn them off real quick. So from the low before the high, let's pull it from the same place, the crypto. Okay. I'm going to go down to the 4-hour and do it. So I'll pull 2 just to double check. So we can pull from there to there. And then we'll pull another one from... Actually, no, that should be it. That's the 4-hour one. We'll pull one from there to there. I think the first one is correct. So yeah, the red one was right. The full move, 256. Held the floor, went to the high. Yeah. Major resistance, 331. That's the floor of the move that you need to regain to take you to the high. That's
So
the
this
gain.
means This means you already have orders around 171 and like 90 baked in.
No, I don't have. I have some stink bids, which is like me just on like some exchanges, like with very very low leverage. I'll put orders in at like in case there's a liquidity event. Like we had that happen on the way up on Binance. They even removed it. There was like a day where Binance fat fingered to 48K back in last summer. But as far as like it breaking down to put levels in, my downside targets are probably going down to at the lowest 30 realistically, and based off the way it moves, you'd be pretty decent to start DCAing in anything under the current floor loss. So anything under 171. 90 is probably like the level that I care about for Binance Coin and a couple other things. So it's all dependent on like what your investment outlook is. Like my stuff, I'd rather do it like lower time frame. If I'm going to start buying stuff, like exchange tokens, that's pretty much on my list of things. Ethereum, anything exchange token, technologies that are really powerful, that are really useful. I think things like Doge and, that don't have any intrinsic value, I think they're kind of scams in a sense, but
you're right.
What do I know?
BNB is a safe bet for the future.
Yeah, unless, BNB starts scamming everyone. Like, yeah, that's the reactive level. Let's see. Yep. So somewhere around here, I'd say just look at that. Somewhere around 95, that's where I'd like it to go. Anything under 180, and it starts collapsing to fill these gaps. $50, I think, is a highly likely one as well if we lose that. And that's all I do with these. Is like I find confluence levels, so I pulled two, one from that low, and then one from the low from the COVID dump, and then one from the low after it made a major high. Right, that's all listing price stuff. It doesn't really matter. So from there, I mean, then you see how reactive that is, even on the yellow one as well. And then when there's overlap, that's the levels I really care about. That's the level we need to hold. If we lose 185, we could potentially go to 170 and then regain 185. But ideally, we go then sub 100, and then everything's collapsing. So,
right.
That's the current target one. So from the low, what am I on? Yeah, so I'm on the 4 hour. And when I'm closer to the price action, I like using lower time frames, like the 1 hour. You can use it on the 15, like whatever you find that's good structure. But like even here, like this is pretty decent, right? See if it's reactive. It might, yeah, I think that's it. Yeah, there you go.
Jesus, this is scary.
Yeah, that's the exact same reaction I had when I first saw it. I was like, that's kind of scary. So, but it's a cool thing. It's definitely it's more of a macro market thing, and it shows you basically like the harmonics of the market and the fact that all of these big, the AIs these people are using to algorithmically trade and how they think. And at the end of the day, like 618, I mean, there's even religions around the golden number and the golden ratio and stuff like that. I think that's yeah. So, I mean, take it a bit as you will. For me, it's mostly like, oh, that's pretty damn cool. And then I look at major levels as price reacts on them.
But I suppose if you would overlap the order blocks with these fib levels, it would like almost come out perfectly.
Yeah, let me get rid of some of them though. What am I on the daily? Let me see, lower. Yeah, really reactive on those. Not so much on the ones that gain above. But it's basically at the major one now. This is the failure. If it gains that, where we got to go? We got to go to the Fib. Or 363. There's nowhere else we can go. And that's why I like trading higher time frame. Like, for newer guys and people who aren't experienced trading in the markets, the 4 hour is the golden time zone because you're seeing enough of the higher time frame move to where you're being able to action on trades, right? Macro, what does this look like? This is failure. This is the main resistance. Your equity trades, your high equity trades are shorting resistance, longing support until proven otherwise. In higher time frame, BNB smacked its major resistance. And these moves aren't small. Like shorting major resistance, put a little 10x on that, you're 2xing your friggin' trade. Not that you're going to catch the full move. You won't ever take profit entirely top to bottom. That doesn't exist, right? We're not taking these trades in the only goal of making money. Like I want to make X amount of money per day. That's not a realistic goal, because when you don't miss the target, it'll emotionally change the way you trade. And like I think we did a mentality thing a couple of weeks ago, but that's probably one of the hardest truths that I had to learn about trading myself is if you have made some really bad trades and gotten wrecked, it psychologically scars you, because you can start counter trading good trades, and you start maybe if you anger trading, right? That's a very possible thing as well. So the problem is that you end up having is if you're psychologically scarred from trading, you need to build up yourself up from like the basics, and the basics is what I try to stay on, which is support and resistance, long support, short resistance till proven otherwise. The fibs and pulling fibs, like that's all fine, dandy, and cool, right? But at the end of the day, lower time frame, 4-hour actioning stuff, right? That's what I care about. I care about the horizontals, and then using, especially since I almost entirely trade crypto, using these things together, even on things like alts, when they line up perfectly, you've got 1, 2, 3 points, 4 points of confluence, plus you're reacting, into a volume block, and then you come back down, even fail levels. Like you can play these out eternally, and the whole thing comes down to methodically trading, where you don't think about stuff. You just have like I used to have post-it notes around my computer until they became ingrained in me. It's like, I will not take a trade unless it's a 3-to-1 risk reward. I will not take a trade with more than on my main account. I won't take trades with more than 1 to 3% of my entire main account, right? By profit target 2, like set profit targets and take, once you make your entry, your profit targets wherever you set them, I will take them no matter what. Like I will not eat. Yeah, like it's like I will. Once price hits that level, I take profit. Once my that's 1, 2, and 3. Once I'm at profit target 2, wherever price is going or has gone, my stop loss is in profit. It's somewhere between my first profit target and my entry. And then just doing those 3 or 4 things, I mean, and sticking to a system where it's like, I need this, and this to happen. Like you can't lose. And that's something we're building out also, is that we want chained alerts where it's like, if I get, if oversold and crossing, if trend change, if value of strength over 80, right, and short signal fires, then I want to enter the trade. And that kind of filtering thing is what's going to make us better and better and better. And that's what I do. That's like, and then I stick to it religiously. I'll enter the trade, set my profit targets, and then as soon as my second profit target's hit, bang, my stop loss is between my entry and my first profit target. And then if I want to, I can take whatever margin I have in that. Like if I put 5,000 on 10x in a Bitcoin position, right? All I'll do is I'll jack that up to 100x and then pull 4,500 out of the position, leaving the minimum margin. Why? Because my stop loss is in profit. I can't get liquidated for that amount, and it's a free trade. And now I've freed up 90% of that capital that I can go allocate somewhere else. But I don't recommend that for people starting out, because a lot of people will accidentally pull. I've seen people pull margin before they do skip a step in there, and then they'll get instant liquidated. So that's a lot, I guess. But any questions, any comments, anything you guys want to or have any thoughts of? Otherwise, I'm probably going to call it that 30 minutes I was going to allocate to this became an hour and a half. They're like, that's fine. I love talking about it. It's good stuff.
No, but this is golden. Thank you so much, really.
Of course, guys. Like that's why you're here. I mean, makes my day. At the end of the day. Yeah, absolutely. And that's, I mean, we can, I don't want to go through every little thing on the different indicators. Like, you can use extra thing. Yeah. But, just the way this is here, like, and my bread and butter is Bitcoin and ETH. Always has been, right? As soon as I can get my swings and my weekly SRs coded so that they automatically plot, I mean, geez, I don't have to do any work anymore. I could just passively work look instead of having to take positions. And yeah, I mean, at the end of the day, the whole point is to become as high probability as possible. And had we had the stablecoin demand in this zone as we failed to swing, I probably would have gotten a giga short on it. But hindsight's 2020, right? It's always easy to look left. It's all about looking to the right, the important shit. And then we can isolate levels. We can see what's important in this zone, what level we don't want to lose. 19.1, 19.2, right? Levels we can't lose. If we lose that, basically free fall down to old levels. And what's the next bigger, older level? By volume, it's way down. So.
And one more question regarding these moving averages and exponential moving averages. We don't care about them, right?
No, they don't matter. They're completely they're made up nonsense, unfortunately. Okay. The problem is that moving averages, they play out until they don't, and at the end of the day, all you're doing is getting a non-specific output of information. And the fact that people as an example, there's people who out there, I used to know a trader, he got wrecked out, he doesn't trade anymore. I don't think I've heard from him over a year, but he was religiously trading Mercury retrograde cycles, lunar cycles, and Gann fans. It worked in the bull market. Why? Because everything's going up. In the bull market, you just long everything. The hardest thing in the bull market is, I mean, realistically, I think bear markets are easier to trade than bull markets because everyone's super emotional. And then bear markets is where 17, 18, that bear market after that high is when I got really, really sharp and good and met a bunch of people who are professional traders, for, banks and investment funds, and basically honed my strategy for scalping. I almost missed the bus on the way up. It took me a while to get my brain around, oh, we're going up, aren't we? I had to trade back at the start of the bull market. I literally was down in here in this crab ass zone, and I had to invert the scale. That's the only way I could take positions. Because I was so psychologically programmed or even scarred from trading in the bear market for so long that my brain just didn't work that way. So.
Right. Well, that's my plan, to get good in this bear market. So when the bull market comes in, I will make some money.
Dude, that's the master plan, man. And that's all we're doing. Is right now all we're doing is accumulating. Right, we're building our stack. A couple of bucks here, a couple of bucks there, right. And then once the bull market starts turning around, we actually have something positive coming into the space as far as general market data, and we see that the accumulation is beginning dramatically. Then we shift our focus from scalping to the harder part, which is why the bull market's harder. You have to find projects, especially crypto, and do fundamental analysis, which is, maybe you want to buy this or buy that for whatever reason. And then being specific about your portfolio. I have, $5,000. What should I spread it into? Being able to evaluate things by risk, lower cap coins, anything under a certain market cap equals higher risk or lower risk, based off the size of it. So, and then we'll go through that whole thing because that's a whole other process. But
right,
yeah, but like you said, right here, it's all about one thing alone, and it's accumulating, liquidity to be able to allocate that in the future. And I think we've got it down to a pretty damn good, almost a science or an art form in this way.
Fantastic. And the last question, what about the Bollinger Bands?
Bollinger Bands. So Bollinger Bands are interesting, but again, they run basically off of a moving average. We use one, like, let me. The problem I have with Bollinger Bands is that, again, they don't base off of horizontals. Anything that doesn't go off of a price level, like going horizontally, and it's a moving average, I take with a grain of salt, because at the end of the day, everything defers to gain or loss a level. Gain the weekly, bullish back test, go to the next level. That's the only thing that goes around in my mind. Layers on top of it, like right now, the fact that on the daily, we have daily potential trend change, overbought, retail stablecoin demand, all kind of pointing to a downside. That's fine, but until we start breaking levels, I don't care. Because some of these things run off of moving average, like the trend stuff is moving average. Bollinger Bands, the same thing. It's basically just moving averages that are offset from the price, and they react based off of volatility. We have one, so I mean, at the end of the day, it's not gospel. If you find a way that you tweak it to the way it works, use it as a point of confluence. But as far as gospel, I'd say you're better off probably trying to use something. Let me just check. Is it on? No, it's on Core Trend, isn't it? The Trendmaster band stuff, and then adjusting the sensitivity so it fits the price action that you're seeing. And the only reason I use that is that it uses a bunch of different bands and then aggregates them by value, and then on higher time frames you can find levels, and they only fire if they're horizontally correct. At which point you start seeing stuff like this. Like on the daily, these things are pretty powerful, and when you do have breaks, it's always price coming settling. Yeah. So even here we can go higher, right? We've got targets at 21.6, which is possible. The other thing too, I guess I'll mention it since we're looking at all this stuff, is the liquidations. I'll go lower because it's important to understand what these things do. So liquidations intraday targeted 150x positions, longs and shorts. Those are very high probability that when price hits these, it's a reversal. They're not gospel, but you can use them if you can't find any other things in your chart. The big thing that I like as well is putting this on bands on 4 hour as an example, because what you can then see is that the current pattern of trading, because these are not moving averages. These are calculated averages of different liquidations by level. So these are not moving averages. This isn't a VWAP band that uses averaging. This is individual liquidations. So anytime we have liquidations on the 4 hour that have broken 3x's, right, 3x longs, you have a significant retracement back to the center of the liquidity. And currently in this sideways move, we have literally only gone from 10x to 10x. Even though the moves have been big, it's only gone 10x to 10x. So what did we just do? We just did a 10x move, right? If price comes up to test the 10x again, it takes us there. Right. And we know, yeah. So we can look at this at a higher time frame reaction. But I really got to go now. I'm really.
Thank you so much. Thank you. Fantastic stuff.
Thanks, guys. I really appreciate it. But I'll see everyone later, and be back tomorrow, 15 minutes before the New York Open, and I'll remember the daylight savings time.
Awesome.
I will. But we'll make sure to have another one of these. Let's say probably maybe Wednesday. Otherwise, if there's not one on Wednesday, then there will be on Thursday, and that's the one with Mr. Bing. And he's going to be going through the automation stuff, tweaking settings to make sure that if you want to use an external service like 3 commas to automatically trade, how to set that up, and basically an intro into botting, because the eventuality is all things will go to automation. We see that's the trend in every technology that exists, and it's going to be the trend in Trendmaster, what we're doing here. So at the end of the day, that's the way we want to go with it, is click and connect, something that trades for you, based on the way that we can, arguably say is one of the easiest ways to trade. And it doesn't, no frills, no fuss, and it saves you from having to build like a $200,000 system on your own, which is like a lot of what these big boys do. They have the money to buy the systems, the bots, the quant trading shit that does it all for them. And I think we can level the playing field quite a bit with what we're building right now.
Right.
Definitely. The future.
Yeah, definitely worth a watch before Thursday, because he'll go through everything a little again, and then go more in depth into understanding values on stuff. Like it's a new world. Like I bought sometimes, but this guy's a genius. I don't think he's taken a manual trade in like 2 years, something like that. Everything he does, like he lives wherever he wants to, like Airbnb, because he literally has bots that auto trade for him and then automatically deposit crypto to his accounts that he uses for cash. So he's a freaking nomad, 100%.
That sounds fantastic.
Yeah, cool freaking dude. I think he's in Croatia right now, just chilling because it's like, why are you in Croatia? It's like, I was in the UK and it was pissing me off. The weather was so shit. I was like, okay, must be nice. But again, thanks everybody, and we'll do the normal stream tomorrow, and I'll make sure to make the event as soon as I get confirmation from Mr. Bing on Thursday for the time. So
Awesome.
until then,
Thank you very much.
Thank you so much. Thanks
everybody. Have a good one.